The number one recommendation that I give to any sponsor before they go out and advertise themselves to the world is to take the time to build a system that is capable of generating relationship with strangers and getting them to a place where they feel comfortable to open their wallets and give them their hard-earned money. The only way to do that is through a large volume of outreach that's consistent and branded in a way where someone will feel an affinity to what it is that your business does.
Welcome, my fellow Flow Masters, to another episode of the Cash Flow Authority podcast. I'm your host, Chris Jansen, founder of the Flow Authority. This show is for high-performing professionals who did everything right. You've got the degree, you've got the income, you've got the career, but you just feel like there's another level out there. There's something else waiting for you. And here we explore how real estate can become that next challenge worth building so that you can take ownership of your future and create a life truly by design. So today, joined by another incredible guest, Mr. Mor Milo. And just a little background on Mor before we get started. Mor is the co-founder of RELLI, which is a platform designed to democratize access to institutional grade real estate investing. Lots of words. We'll unpack all this stuff as we go through. But together with his co-founder, Ross Steiner, he built RELLI to function as the stock market of real estate, giving investors a way to discover, compare, and invest in real estate opportunities with greater transparency and lower minimums. So welcome, Mor, and excited to have you on today.
Hey, what's going on? Glad to be here. Thanks for having me, Chris. I do get to make a little tiny correction for you, though.
Please.
For some reason, someone put out the word Steiner for Ross, who's my business partner. His last name's actually Einarelli. He would kill me if I didn't say the name. But not your fault. Not the first time I've heard that. We're working on scrubbing that from the internet.
All right. Well, thanks for the correction. I appreciate that. And well, hey, tell me a little bit about this. Is an interesting idea. You know, a lot of people just want to get into real estate and, I don't got the money. And so, you know, as a coach, I can help guide these people and show them different ways to fund deals without their own money. But this seems like another interesting way where maybe if you just have a little bit, you know, to put into it. I mean, how does this work? Maybe just talk a little bit about this model.
The idea is to create a stock market for real estate so that anybody can invest in real estate. I don't know if you've noticed, but we can bet, and I use that word very strategically. We can bet on anything in today's market using Polymarket or your favorite crazy betting site. If I wanted to bet on the color of the Gatorade at the Super Bowl, I could do that. But for some reason, passively investing in real estate syndications and funds is incredibly difficult. And our goal is actually to make that incredibly accessible and easy for people to understand. And the story really is me and my business partner, Ross, I have now built 4 startups. This is our 4th startup. And after a few failed business attempts, we looked at the market and said, okay, what the heck can we do to bring value to people? And we had both invested in stocks and cryptos and done really well, but we didn't have real estate. So we wanted to get involved, but we didn't want to have tenants because I had watched my family buy single family real estate for a long time, and very effective strategy, made them lots of money, built lots of freedom and success for them. But personally, I wanted to be able to do something more passively. So we discovered that there were really no good options, even for high net worth individuals, to be able to view and access deals all across the country, eventually the world, that had different sectors to invest in, great sponsors with track record, and a place to centralize all that information. So we decided to go out and try to build it.
Okay, awesome. So how does this compare to like a REIT? Because some people who do invest in the stock market, they might see REIT and think, well, can I just go buy some shares in a real estate investment trust and call it a day? And frankly, I don't really know. I mean, I don't know the difference between a REIT and all these other things. And why not just buy pieces of a REIT? I'm sure there's things that you're not getting by buying a REIT that you would being part of an actual syndication.
Absolutely. REITs are phenomenal. We actually have a REIT on our platform today. A REIT is essentially a tax designation for a particular type of fund that has a certain requirement associated with returning a percentage of the capital that's generated back to those investors. And what you've heard of is publicly traded REITs on the stock market, where you can get a piece of the action of a big company that's giving you a little bit off of all of their portfolio of investment opportunities. Great way to go. REITs that currently exist to the average consumer are few and far between and normally don't give you lots of direct access to assets. So what RELLI does is it gets all of those syndications and funds that are available on the private markets from highly trusted sponsors that have done this time and time again. And we bring them to a platform where it's centralized and an investor can see all the different options in one place, where we don't actually take any sort of commission. And our only goal is to give you access to the deals and connect you with the general partners that have hired us to bring them access to new investors. So we actually don't take the capital ourselves. We make a connection for our investors directly with the people that they want to invest in, and they are able to have that private type of relationship to deploy their capital and make a return based off of a lot more options when it comes to different types of assets, but also through investing in syndications where they can have direct access to a specific property or a small portfolio of properties, where unfortunately with some of those larger REITs, you don't have a lot of control on where you're putting your money. You kind of give it to the company and you hope that the company grows in value.
I see. Okay. Makes sense. So how do you find these sponsors, and are you guys vetting these deals yourselves? Like, how does this whole thing work?
We sure are. So what you'll love to know is that there's a whole industry that's living behind closed doors, where private equity firms that focus on real estate development or real estate management have for generations been generating returns for higher net worth individuals. And most of those deals was on a need to know basis. If you know the guy, you know the guy. If you don't.
Right.
And that entire industry has been built off of deals being done between a closed network of people. And what's happened over the last 10 years is many more sponsors have come to the market with some of the new regulations associated with the Jobs Act, which is not really new. They've been around since 2012. But these regulations allow for those private syndications to actually be publicly solicited. So now these sponsors are actually going out to the market and saying, hey, we've delivered great results for 100, 1,000, 10,000 investors. Now we want to find new opportunities with complete strangers and give them access to our investments as well. So what we do is we go find those real estate sponsors that have 100 million, $500 million, multiple $1 billion worth of assets under management that have a proven track record of success, and we show them how to leverage our digital marketing solutions to get in front of new investors. And by doing that, we give access to these investors to deals that they normally would never hear of. And because we do it at scale with lots of different sponsors, we have the ability to show a diversified portfolio of different types of investments that someone can invest in, all from the comfort of just logging into our online platform.
Gotcha. Okay. So for those listening who don't know this, if you are a sponsor or you're trying to get into multifamily and raise money for these deals, I just know if you're going to do these other methods, which like there's Regulation D, 506B, which is the friends and family hush hush, don't advertise kind of way of doing it that Mor was talking about. There's also 506C, which you can advertise, but then everybody has to be accredited, and things like that. But these things, they cost, 10 to 20 grand or so for the attorney fees just to file all the documents, to be compliant, to file this with the SEC and all this. How does that, do you guys do that for your sponsors on these deals? And is it a completely different exemption altogether? Like, is this a crowdfunding thing? And how does that kind of compare, I guess, on a cost basis too?
So first of all, really astute questions. As you know, with 506B, and just to kind of give the audience the background, 506B is only for that closed community. So for the most part, the deals that we see on our platform focused towards accredited investors are 506C offerings, which C is in cat, C is also in with your eyes. And by being able to see those offerings, you can actually generally solicit them on platforms like Facebook and Instagram and a platform like ours. The majority of the deals that exist in the market that we work with are those 506C offerings. Now, in addition to those exemptions under Regulation D, There is also another set of exemptions through Regulation CF and Regulation A, which is what we see most often, where an investment firm can actually diversify their investment pool to the average consumer as well. But as you mentioned, depending on the level of scrutiny associated with the SEC, there is a cost associated with legal and compliance to make sure that you're doing everything properly. With a Regulation D, on the low end, you're looking at as low as $5,000. On the high end, you could see boutique firms charging as much as $50,000 to build out your Regulation D offering. With Regulation A and Regulation CF, those numbers are jacked up a little bit because you have quite a bit more that goes into it from a compliance standpoint, but it also frees you up to offer investments to just about anybody in the United States over the age of 18, which is pretty amazing. For a sponsor to be on our platform, they will need to have a generally solicitable offering. So normally we see sponsors that have a little bit more of a track record, a larger AUM that they leverage to be able to get on a platform like ours. And we also see that 10 million, 20 million, 50 million AUM sponsors, which I know sounds like a lot, but you take one multifamily offering and you're already at $10 million, right? Those sponsors are also starting to build systems and leverage Reg D 506C such that they can get out in front of consumers as well and find new investors for their deal. So although there is some cost associated, I would say that in the last 5 to 10 years, that cost has dramatically come down because of the accessibility of all the new technology tools that make some of that legal processing of word processing easier. And it definitely requires a little bit more legal and financial documentation to be able to get into that game.
Yeah. Okay. So it sounds like the sponsor has to go out and get the offering built themselves before they come to your platform, right?
I didn't fully answer your question. We have relationships with attorneys that can deliver those solutions on all sides of the spectrum. Okay. The super affordable, technology-driven legal service that will deliver that for you for $5,000, or the super boutique, experienced, dialed-in firm that's going to handhold you through the entire process that's going to charge you $50,000. We have relationships across the board that we can introduce to sponsors, but that is something that you want to have a legal professional do on your behalf.
Got it. Okay. Makes sense. So going back now to kind of like your model versus other models, if you will. And this question also, I think, just for the listeners who want to get into passive investing generally, whether it's through RELLI, a platform like RELLI, or just directly with a syndicator, what are some things that the passive investor should look out for in the pitch decks and whatnot, or questions to ask of like, hey, what's my actual return? Because I've taken classes on this too, and they talk about this, and it's like, there's so many little tricks and it's kind of messed up. And so I understand why there's such heavy regulation around it, right? So what are some things to look for and questions maybe to ask to really pull out, hey, what are you actually projecting that I'm going to get as a return? Because I don't really care how the fund does. I care how, what is the benefit to my pocketbook,
money,
right?
Baby, where's my money?
Exactly.
100%. So, okay, number one, I've never seen projections go any direction other than up and to the right. Okay? So, no matter which way you slice and dice it, the pro forma that they deliver you is always going to be the rosy colored glass view.
Yeah.
Now, the number one thing that I would recommend is, first of all, get a team around you. So, Chris, you building your community, bringing people together so that you guys can have access to each other to be able to scrape up against each other and challenge one another. That's a great place to start. In addition to that, I would recommend talking to someone who's invested in syndications before, talking to someone that represents you from a financial standpoint, that manages your finances, and maybe potentially even talking to a lawyer when you're looking through the documentation to make sure you're confident. Now, I realize that's not feasible for everybody on every deal every time that they look at a deal. But that would be an ideal situation, and what we do internally to do our due diligence and make sure that we know what's going on. What I would recommend any private investor do when looking at a syndication is, once receiving all that documentation, number one, read through everything. Read through the PPM, read through this. PPM is a private placement memorandum. It's basically like the big contract that gives you an idea of how they're going to operate. Read through the subscription documents that tells you what you're actually buying. Are you buying membership interest in a company? Are you buying a promissory note that'll pay you a certain amount of money over time, right? And then also look through the offering memorandum in the pro forma. And instead of just looking at it and saying, okay, this looks good, take those numbers and stress test them. Okay, what is their cost to build per square foot? Does that correlate to the location that they're building in? Are they building or are they doing value add? If it's a replacement cost of X, is that what we're seeing in the market? Or is Y completely different in the market and what they're providing me is something irrelevant to what we know based off of data? At which point, either you can say, okay, this is completely outrageous, or you can go back to the sponsor and say, okay, we see that it costs $300 a square foot to build here. You're showing that replacement cost is $215 per square foot. What is the deviation there? It's almost 33%. That's a big deviation. Why do you believe that you're going to be effective at delivering on that $250 or $215 a square foot? And let them justify. Well, we're vertically integrated. We already have all the hardware. We already have all the supplies. We're ready to go. Whatever it is that their story looks like. And then stress test the story and see why do you think you're in this optimal position? Because as we know, what the pro forma says and what happens in reality are two different things. So what you get to do as an investor, because at the end of the day, once you give them the money, it's their job to go and deploy that money. So the job is already done. Your job as an investor is already done the second the money is deployed. Before you deploy that money, you really need to understand the mindset of the sponsor, how they're going to overcome obstacles on the road to delivering on the product, what is their contingency plan. And if you take the time to stress test all those numbers and actually stress test the strategy against what you've seen that works in the market by doing some very simple research, you can use your buddy Claude or use whoever you choose from an LLM standpoint. It'll deliver you all that information, right? But that way you have an argument against the sponsor of what's concerning you in their deal, and they have to then justify those numbers back to you, and then you can make a more educated decision. But what you'll notice is that if you do stress test a sponsor and you do put them up against some assumptions that you've created, you will very quickly see how ready that sponsor is to respond to those obstacles, because most people don't do that, right? And if they're ready and they have good responses and they know what they're talking about, they will actively prove it to you by telling you how they're going to be effective.
Or maybe your question will help them do a better job. And like, hey, I didn't think about that. Okay, let me get back to you and actually do that research that I should have done, which then, then it's up to you if you really want to. But hey, to your point,
I would argue that's a good thing to hear. I would argue that's someone that doesn't care what things look like and they care about results, right? If they say, hey, that's... I didn't catch that. Because look at that. That's actually someone that's open.
As an engineer, and this came up on a recent episode too. But as an engineer, who's great at spreadsheets. I mean, I know how easy it is to fudge a number. Instead of 20%, make it a 21, 20.4, and it'll still round to 20. And now, you know what I'm saying? Like, there's like all these hidden things you're never gonna see. You're just never gonna see them. And I'm not saying I do that, please, but I'm just saying that I know that others are doing that, and there are ways to definitely trick the system. And one other thing that I heard, that I just remember from the class that I took, it was a class on launching a fund, so a lot of overlap and stuff. And on there, they were also saying that a lot of funds and syndications will just advertise an IRR, but that IRR is for the fund; it's not your return. And so just asking that question, well, is that IRR for the fund, or is that my IRR after management fees, acquisition fees, disposition fees, whatever other fees are included in there? And make sure you know what the fees are, as well. And so there's a lot of things. So as an engineer, and a lot of folks listening are in that kind of field, so I think they can all relate to this. But we meticulously do that naturally. We go through and look at all the nitty gritty details, and we're probably sponsors' worst nightmare because we're just asking all the questions that they don't want to be asked. But peace of mind is everything. So that's what that does. And I think it's prudent to do that if you're going to be saying that, we're all trained to dump all of our money in the 401k into God knows what. And even when I knew nothing about stocks, I still was choosing because I'm like, I don't want somebody telling me where to put my money, you know. And I was trying to research and look through all the documents to figure out, okay, let me look at the returns. Let me figure out what makes sense to at least make some educated choice. Because all I ever heard was, hey, have a 401k. Please have a 401k. Put all your money there. You know, max it out. Anyways, I'm getting way off topic, but maybe you have some points on some of those comments.
I think we do this. So I do this. We do this across the board. And
Yeah.
I love the stock market. I love to invest
Yeah.
in stocks, and I have lots of friends that also invest in stocks and have different strategies around it. And what I've learned is that nobody's truly educated on this stuff. Usually, the strategy is following somebody else's, advice and just doing what they do. But rarely do we take the time to understand why. And I think when looking at private syndications, especially those that are in real estate, because they're pretty digestible, right? It's like, here's the piece of property. This is what it does. This is how much it generates in income. This is what we think the market is going to do in the next couple of years. What do you think? Are you interested? I think when you start looking at macroeconomics and looking at the stock market and how is, the chip industry going to do with all the new stuff that's happening in the world, we make decisions on those types of investments without any knowledge, which we definitely should change. And just like when you invest actively in a single family residence or in a multifamily deal, you're going to underwrite your deal. When you're investing passively in an operator, it's even more important to do that underwriting because that's the number one thing that you can control. You can control where the money goes. So from that perspective, build a strategy to underwrite that deal just like you would underwrite an active single family residence deal, and have certain parameters that you're looking for such that when you find a new deal, does it fit into what I'm looking for? Does it fit into my strategy? Does it fit into the KPIs that I need to have to make a decision effective for me? Mm-hmm. And I think sometimes we forget to do that with our 401k or with our Roth IRA or with any of the insurance policies that we buy, because usually we are trusting whomever is in front of us pitching us or selling us that product.
Right. Yeah, and I feel like those are two personality types. And they're kind of extreme ends. There's the engineer mind, analytical mind that is going to look through every rabbit hole and probably way overanalyze it because you're never going to know anyways what's going to happen in the future. And then there's the other side who's like all about the heart and the relationship, and it's just all about trust. And I don't really care. I trust you. You told me to do it. I'm doing it. And that can be great, but it also can come back to haunt you, right? So, I mean, there's got to be some balance, and that's tough because the analytical mind is like, where does trust come into this, but at some point you got to make a decision, and maybe that trust piece is what takes you over the edge of, okay, I've analyzed enough, I've asked enough questions, and I trust this person, let's do it. And then the other side is, you trust them, but hey, ask a few questions, like at least like just pierce it a little bit. Let's stress test, as you said, right? And really make sure that this is the right move. Just to, again, give yourself peace of mind. Then if the deal goes wrong, I mean, sometimes deals go wrong, but at least you did everything you could at the beginning to make sure, that it wasn't going to go south. And then you're going to learn something from the process. If it does go south, learn something for the next time, please.
That's the one. Yeah. And look, the beauty in if you do the underwriting properly and you look at the numbers and you dig into the numbers and you make those assumptions and you stress test and you do all the things that need to be done before making the decision. If it goes sideways, you can go back to your analysis that you made before you deployed the capital and see what happened in terms of what actually transpired, and then reflect that against what it is that you made your decision based off of, and then take that in an analytical way to the next deal, as opposed to, I got burned with these guys, that sucks, I'm never investing in multifamily again, I'm only looking at retail. It's like, no, you probably could invest in multifamily again, but what was the variable that you missed? What was the thing that you thought was going to deliver the results that you wanted but missed the mark? Where is it in the pro forma? Where is it in your analysis? And how do you take that learning and actually bring that process into your decision-making engine, let's call it, right? If you build a nice little underwriting system, and adjust accordingly for any of your future deals so that you can invest in multifamily, but you're a better, more educated investor.
Yeah, absolutely. Absolutely. And that's true for the active investor too, for the operator, because obviously, if you do have a deal go south, you're going to have to answer to that. But an even better story than, oh, I've never had a deal ever go south, I'm perfect, right? An even better story is the redemption story. Everybody loves a good redemption story. So, no, I had a deal go south, but this is what happened and I learned from it and I kept pursuing anyways and persevering. And now I've done this many deals since then and I've adjusted and course corrected. So if anything does happen and start to go south in this deal, I'm going to recognize it. And here's why, and that's an even better story and probably gives people more comfort than, no, I've never done a bad deal. Oh, then maybe this is the deal that goes south, right? Because everything's all sunshine and rainbows for this operator, and that's just not reality.
There's always a day. There's always a day for a first, right?
Yeah,
And one thing I mean, you can't bat 1,000. It doesn't work like that. It just doesn't work like that.
yeah,
So yeah, you might as well take it as an expensive lesson and make sure that you know what went wrong and why, so that it doesn't happen again.
yeah. I did want to ask this question. It's a little bit off topic from what we were just talking about, but for the sponsors raising capital for the first time, maybe, or they've only done a couple smaller multifamily deals, commercial deals, like where's the bottleneck? Where do they start to get stuck with raising capital, and why is that? I guess what's kind of the biggest thing that holds them back?
And this is something that I see from startup, first fund, first syndication, all the way up to multi-billion dollars in AUM, publicly traded, the whole 9 yards. This is a problem that I see across the entire board. There is a lack of automation associated with outreach. Okay. And that sounds really boring. And it sounds like something that is like a given.
Yeah,
But people underestimate how difficult it is to get someone, an individual, to believe in you enough to part ways with $50,000, $100,000, $200,000. Doesn't matter what the deal is. It's a big chunk of money. It requires a lot of responsibility. And for the individual, it requires you to actually have some form of affinity for the person that you're giving the money to. Most real estate sponsors are, for lack of a better term, spoiled with institutional relationships where the negotiating party on the other side of the table has leverage because they're capable of delivering a large check. Think about your lenders, right? If you've never raised a big check from an institution, think about lenders. They have the leverage to tell you, no, unless you meet these stipulations,
yeah,
we will not give you this money. Now, for those who can get in front of those institutions and close business, amazing. But the second that those institutions are distracted, most sponsors try to fall back on retail relationships, average consumers, private investors that want to deploy capital. Private investors don't have the leverage to negotiate how much money they get in return, what type of structure they have of ownership, how much ownership they have in the deal, what the timeline is before we replace the manager. They don't have any of that control. So the process for selling them is completely different. Where the institutions are ready to write a check and they'll engage you fast and they'll make a decision fast, the retail investors want to feel like they know you and want to build a relationship with you. Just like any other person buying any other product from any other company, especially ones that are high ticket. So the number one recommendation that I give to any sponsor before they go out and advertise themselves to the world is to take the time to build a system that is capable of generating relationship with strangers and getting them to a place where they feel comfortable to open their wallets and give them their hard-earned money. The only way to do that is through a large volume of outreach that's consistent and branded in a way where someone will feel an affinity to what it is that your business does. So build a CRM, come up with a strategy to take a brand new person and turn them into a warm relationship that then eventually gives you money, and find a way to automate it. And if you need help with all this, we're here to help. But by having all of those functions in a system, a technological system that automates the outreach, as a smaller operator, you can focus on the things that drive the business while ensuring that you consistently are building relationship with people through excellent educational content, consistent outreach, scheduling meetings to build relationship on a Zoom call or in person to get these people to know who you are and what you're doing, such that when you ask them for money, they are actually willing to give it to you.
Nice. That easy, huh?
Oh, it's so hard. It's so hard, dude.
Yeah.
It's so hard.
I mean,
Look,
even for my coaching business, I mean, I hire virtual assistants to do that kind of stuff because it's just, I could learn it. Yes, I could learn it. I probably should learn. I probably should learn these things. And I've built some very, very simplified automation, right? But even just doing that, it's always broken and I never know what's going on. I'm just like, oh my gosh, and I'm like, am I really building a relationship or am I just being a pest and all this? Because like you said, it takes volumes, but probably, it takes volumes, but it also takes, like you said, the right messaging, the right branding, all the things, all the pieces, a lot of pieces to that puzzle. And,
you're wearing interesting articles of clothing right now, which represent a guy who people have feelings about, but is one of the pinnacle operators in our business. Okay.
Yes.
Grant Cardone, if you ever go and send him a lead, send him your information, I would recommend that you watch and see what he does.
Oh, I see.
Because
I see. I got 2 emails at the exact same time today. I'm like, okay. Every day, just pounded it away. And I'm just like, all right, I still want the emails because I like some of this. I like probably 1% of the emails, maybe less, but I still want the emails for the 1%. And I just let it come in.
But you just nailed a really interesting point there, dude. You nailed something very interesting, which is that people want to see your content. So, for example, if I go on social media, like a big methodology of generating opportunity for our sponsors is through Facebook advertising and Instagram advertising, right? We do that for our customers. It works really well. When someone raises their hand and says, hey, here's my information, I'm interested in your brand, I'm interested in your business, they aren't always ready to just jump on a call with you. Most cases are actually, they don't want to jump on a call with you. What they want you to do is they want you to take that email, plug it into your newsletter or your outreach, and they want to see your content. And over the next 6 months, they're watching to see what you're doing. And maybe they like 1% of the content that Grant sends, but they're not going to turn it off. Why? Because they want to see what you do. They want to see how you act. They want to see what deals have happened since you sent in the lead. They want to see what your brand looks like. They want to see how people are engaging with that brand. And they also want to see how they feel after a year and a half of getting outreach from you to say, okay, you know what? Now I have 150 grand. Now I have 200 grand. Now I need to go make an investment. Let me see who's in my email for the longest period of time, who's been the most consistent. Oh, Grant's been emailing me every day for the last 3 years. Maybe I should take a meeting with them and just see what they have to offer.
Yeah.
Right? And it gives you that at bat. Might not close the business, but it's going to give you that at bat. And without that at bat, you don't have a chance anyway. So you might as well get the at bat.
Yeah.
And I think, and to give you a correlated situation with a customer that we have that is incredibly good at what they do. Okay, they're a publicly traded company, annually audited by EY. They have over $5 billion in AUM. They've raised about the same amount of money with 1/20th of the number of investors that Grant Cardone has. He has 20,000, they have 1,000. And they have been really effective at raising capital from people within their network. Now, for them, that means $1 billion and change, which is crazy. Good for them. For most people, that number is 10 million, 20 million, 50 million, 100 million. And then they reach a point where they're kind of just like, okay, what's next? What's next? And that's when you have to make that transition as a big company to shift your mindset. But if you can start from the very, very beginning with the mindset of understanding volume, understanding relationship, understanding corporate sales, the process of growing becomes easier, not harder.
Yeah. Yeah. Nice, man. Calling out the GC, Uncle G. I love it.
Look, he's whatever you feel about him, the guy knows how to do corporate sales.
Oh, yeah.
And at the end of the day, that's what business is, man.
Well, there's a reason why I'm a 10X certified business coach. So I went through his whole thing and learned a lot about sales in there. But that's why I include his sales training, Cardone University, with my coaching platform, because no matter where you end up in real estate, you got to know some form of sales, at least the basic sales cycle and what that looks like. So, and no other coaches are doing that. No other coaches are including sales training, maybe a little bit of negotiating tactics, for real estate. But anyways, thought I'd throw that out there. But hey, we're running out of time. We might have to do another episode together because you're just a wealth of knowledge, man. I appreciate it. But before we go, where can people find you? And this will be in the show notes too, but what's the best way people can connect with you?
First of all, please come check out our platform. It's called RELLI, RELLI.co. So CO, not com. And that'll take you to our platform. You can create a free account. You can check out all the deals that exist on there. You can connect directly with sponsors. You can connect directly with me and my team. In addition to that, if you would like to check us out on any of our social platforms, we're at Invest with RELLI, and we're on all the platforms. Me personally, my favorite is LinkedIn. So if anybody wants to connect with me directly on social, LinkedIn is the best place to find me. My first name and last name, M-O-R, last name M-I-L-O. And I'd be more than happy to connect with whomever I can support.
All right. Awesome. All right. Well, thanks, Mor. Appreciate your time today, and we'll talk to you next time. Thanks for tuning in to this episode of the Cash Flow Authority podcast. We hope the insights shared today help you take the next step toward optimizing your finances and building sustainable wealth. If you enjoyed this conversation, please take a moment to subscribe on your favorite podcast platform and leave us a review. It helps other entrepreneurs and investors discover the show. And don't forget to catch the next episode for more insights. Until then, keep mastering your cash flow.